Welcome to the Southeast Retirement Planners Podcast, where we will go beyond the balance sheet with our guests, not only to share from our personal experience as financial advisors of over 25 plus years, but also to learn from our guests about the issues and topics that are important to them. Our firm specializes in taking care of the financial plans for individuals and small businesses by helping our clients identify their individual goals and taking a conservative and ongoing approach to helping accomplish them. We are located in Hickory, North Carolina, and look forward to continuing to serve our clients and our community. Thank you for joining us. We hope you enjoyed this week's episode.
Welcome, everyone, to the Southeast Retirement Podcast. We're happy to have you join us today. I am Ryan Edwards and Les Stewart. We're here together today and happy to have you. We're going to start talking today about life insurance and the importance of and the different types. But before we do so, we'd like to just talk a little bit about who we are, what we do, and you can find out both a little bit more thoroughly online at our website, scretirementplanners.com. We'd invite you to join that or click on that website and find out, as I said, a little bit more about our team. The website has a tremendous amount of information and resources on it. You can get updates on the market, and also for our clients, it's a place where they can log in. You can also see previous podcast recordings as well as webinar recordings. One of the most recent that we uploaded was on the potential tax law changes coming up for 2021 and 2022. So just a great way to familiarize yourself with us and our team. And Les, this is a topic today, life insurance, that is very important, but unfortunately something during this pandemic that we're in, it's something that we've had to really take a hard look at and want to make sure that we're having those discussions with our clients. Yeah,
we insurance is probably not our favorite part of this business that we're a part of. The financial planning process of it involves that, but you and I we enjoy the investment part of it and the spending part of it and that kind of thing. But the insurance is a big part of the planning process as well. And this pandemic has brought mortality. The fact that you never know when something tragic could happen to you or a family member, and it's not something that we as humans, I don't think, like to think about much. But if you don't plan, it's just like everything else. If you don't plan for that event, then the worst case scenario is likely to happen when that does happen.
Right.
So I feel strongly about it, that it needs to be discussed with everyone, and everyone needs to think about whether it's right for them or not.
Right, and it is just a topic that is, for many people, it's uncomfortable to talk. But I've not met anybody I feel very confident it's going to live forever. So our day's going to come for some earlier than others. But why is it needed or why is it not needed? And we get asked that question quite a bit. The most useful way to kind of answer that question of whether you specifically need life insurance or not is, would your death financially impact the people in your life?
That's right.
And I think that right there is just a great way to if you can answer that question, if that answer is yes, then you should consider life insurance.
Right.
Period. So, and let's talk about that. Life insurance is a contract between you and an insurance company. And where you pay insurance premiums, you have to pay for the coverage in exchange for the insurer's commitment to pay what's called death benefit to specific people or organizations if you die while the policy is in effect. And the people who receive this benefit, this death benefit, which could be your spouse or children, for example, can use the money to cover financial needs, whether that's paying household expenses or covering covering debt.
Right.
And let's go, before we get into why it's not new, let's go into some situations or scenarios, and we're going to cover two specific today with kind of real-life situations. But before we do that, let's kind of review a few scenarios where your death would most likely negatively affect someone else financially. So that one would be someone would inherit your debt. You know, you're carrying debt, and your spouse or your partner relies on your income. Maybe your children depend on your income. Your minor children are unable to provide for themselves, and you would almost certainly be put in a major disadvantage if they had to replace your income. Sure. So those are some main things. Your heirs would owe estate taxes. And then right now, you know, you may think, well, my situation, I don't necessarily have an estate tax issue. And at $11.5 million, maybe you don't.
Yeah, but that never changes.
That never changes. As long as we're going to have politicians, that will never change, that rate. So $11.7 million is what that figure is today or in 2021, but there's legislation. The rumor is it's going down to $3.5 million.
Yeah. So that's been proposed or
been
thrown around in Washington.
And we've got this thing called the national debt. You may have heard of it. It's getting greater by the second, by the minute, and they're looking potentially for ways to tax and
now,
bring that down.
If I remember correctly, don't quote me or hold me to this, but I think it was at $1 million at one point, wasn't it? Anything over $1 million or somewhere around. It was pretty low at one point in the 80s, and during the Bush administration, they raised that quite a bit.
They did. That was the year there was no estate tax.
Right.
And that's the year your favorite team's owner, George Steinbrenner, died. His family paid no estate tax.
Right. Right.
So if you were going to die with an estate, that was the year you needed to die.
He was always a winner.
He won. He beat the government. But if your heirs would have owed estate taxes, we just covered that. Your funeral would be a financial burden to the people that are left. The average cost of a funeral is close to $8,000, the average cost, and it could cost more depending on your wishes at that time.
So with all this back to the estate, kind of really pointing back to the estate tax, why would life insurance be a help in that situation?
Good, yeah. Well, if your assets total up to above whatever that estate tax determined threshold is, your heirs are going to have to pay a significant tax, close to up to around 50% on the dollars above that level.
Right.
All right. Now that's after your spouse. If it goes to your spouse, there's a threshold, but what it normally encounters, that large estate tax burden, is above that level.
And in almost all situations or most situations, life insurance benefits are tax-free.
Tax-free. So for those that would go above that level, life insurance would pay out a tax-free death benefit that, in essence, you would use it instead of your heirs having to maybe fire sale some assets, they would have that death benefit there to pay that estate tax.
Right.
Well, there's two other reasons why life insurance might be appropriate or certain situations. Your funeral would be a financial burden, as the median average cost is around $8,000, and it could be higher based off your wishes. And another reason would be your business and the people that it employs. That might be a situation where if you're not around any longer, then the business may fail if it didn't have you at the helm.
So you and I are a great example of that. We're co-owners in a business.
Exactly.
Each own half of the business, and we each do specific duties that are important to the business. Now, everybody tries to set it up where if your business is set up well, it could run without you, and that's kind of a goal that everyone should work toward.
And we think we have a good succession plan in place with each other. We've always said two heads are better than one, and we have life insurance in place to take care of that burden. But many businesses owners we found don't. They're kind of the CPU of the business. Their head is the and what they have inside that head. If that head's no longer working and they've passed away, then the business will go away, and life insurance could be a way to bridge that gap until someone comes in to continue that business or succession plan.
But the other option is my wife could just come work with you.
And I think the answer was the same as if that happened on my scenario, and Amanda could come work with you. So therefore, we have life insurance.
Plus, I don't think they would want to work with one of us anyway.
No, exactly. So it's we're thankful to have those succession plan in place, and neither one of them they will benefit, but not working with each other or with one of us. Now let's talk about, those are some reasons why you need it, but let's say, why is it not needed? And if no one in your life would be financially harmed by your death, then you can likely put off investing in a life insurance policy, bottom line.
Yeah, so I would say not many people fall into that. Possibly if you're retired, have no debt, and no expenses outside of
ordinary,
that might fit you. If you've got if you have a ton of savings, or not a ton, but you have a low lifestyle and have a great amount of savings or a good amount of savings, and
your stocks, bonds, retirement assets,
and once again, no debt.
Right, no debt. Then but very important to keep in mind that the younger and the healthier you are, the more affordable life insurance will be. So if you see major life changes coming up in the future and you don't feel like you have the retirement assets and those assets you mentioned in place, then it's probably better to look at life insurance now than later.
Right.
Because every day, I heard somebody tell me a long time ago, when you're talking about life insurance, every day we're closer to death.
Sure.
And it becomes more.
Yeah.
It becomes more expensive because you're one day closer, and that gets us into what you're asking. Or we wanted to cover is what kind of life insurance do I need? And there's if I do need it, there's two different types of life insurance. It falls into basically two different categories. There's a number of different types of policies, and it's term life insurance and permanent life insurance. Mm-hmm. And term life is temporary. It's the cheapest for the most amount of money out there.
Right.
When we look at term life providers, we're looking at the highest rated company. You don't want to outlive your insurance company, and you want a good, solid, high rated. And term life provides the lowest cost for insurance for the most amount of money. And that term usually runs for 5, 10, 20, or 30, or another set of number of years.
Right.
And you can continue paying after that period of time, but it is an astronomical, usually. It's coverage for a certain specified period of time.
Right.
Many of our policies that we write, or most all of them that are term, and most of them out there, I shouldn't say all by any means, you have the ability to convert your term policy to a permanent policy. But let's say if you have a potential estate tax policy, a permanent life insurance, it covers the insured person until the end of their life. So as long as you pay premiums, you have coverage.
Right.
And that's because we don't know when that day is going to come for us. And you're trying to cover a potential estate issue, then term probably is not going to be that's probably not going to fit your needs. Because you just don't. What if you can't take out a 30-year policy right now, or later on, then you live 31, 35 years, then you won't have coverage unless you pay an astronomical rate.
That's right. So if you can kind of see that I guess the point there is if you can kind of see the trajectory of your life is where you're going to have significant wealth or a significant need of coverage, the younger you can jump on that, more often than not, is the best time to do it.
That's correct.
And the other factor that we really haven't talked about is that the insurance company looks at is your health. So leading to health, just like health insurance, leading a healthy lifestyle and maintaining a good weight and that kind of thing, keeping bad habits out of your lifestyle helps your premium, helps life insurance be cheaper because the insurance company, through their analyzation of numbers and real world facts, have found that people with those traits live longer, and people that have poor lifestyle live shorter. So it's pretty simple.
Yes, it is. And there's different, term is very simple, but there's different types of permanent life insurance that people that are listening may have heard. There's whole life, there's universal life, and there's variable universal life. And those are all permanent type policies that covers for a person for as long as he or she lives, as long as they continue paying the required premiums. We feel as a firm that if you're going to invest. If you're going to buy insurance. And while we think there's a need in certain scenarios, we're going to cover two here in a few minutes and then kind of back into which ones we would propose. But universal life, variable universal life, and whole life policies can all provide protection, but they also have the ability for an individual to accumulate a cash value inside of them. And whether that's appropriate or not is based off each individual situation. So we could talk the rest of the day on the different types of life insurance policies, but for our conversation today, we just wanted to stick to the two, basically the two categories that all of them fall into.
To keep the conversation revolving around. I mean, really, when you want to just really dumb all this down, it's, you want to take care of your loved ones and make sure that their basic needs and everybody's basic needs are different, So a basic need for my family might just be, making sure that they have a roof and food. A basic need for your family might be that they have a BMW to drive around. I don't know, but really that is different depending on the person. So it goes full circle back to planning, which is why you want to sit down with a reputable financial advisor and talk through all of this, and why financial advisors should be looking at your insurance.
That's right. And one of the ways that we interact with our clients and try to assess their life insurance needs is using a software that we've spoke about in the past, and you can find it online under our webpage under Make a Plan.
Right. And
it's the Asset Map software. So we've got a scenario that we've pulled up using the Asset Map, and this is an example case of a JV quarterback, I guess, for the Tampa Bay Buccaneers, Tom Grady, not Tom Brady. So he is falling on hard times here and is only making $160,000 a year.
Yeah, so he's a guy in his early to mid 40s, has a wife that stay-at-home wife, stays at home and takes care of his three children, which are age 16, 13, and 3, I believe. Makes a good, a reasonable living, has taken a little bit of initiative and saved in his 401k at work and kept his debt down, has a nice house, $400,000 house with a $300,000 mortgage on it. Nothing too exciting. He's even saved a little bit for his kids' college, about $25,000. So it looks like he's in really good shape. He is.
And we run into this. Yeah. This is not just we joke and say Tom Grady, but this is several scenarios.
It's an exact case that I talked with a client of mine just a couple weeks ago.
That's correct.
But if you notice, above Tom and Drizelle's heads should be that space is empty, and it should be. That's where the life insurance area goes, or where not just life insurance but insurance period goes.
So exactly. So why would there be a need here? Well, if Tom passed away in this scenario, his with his wife not working outside of the home, which she has a full-time job, it's just
Right.
not paid for it.
Right.
He is the main income winner. So there would be a need for income.
Right.
And if we went through the scenario, if she's not working, many widows, as we've encountered, worry about the house. How am I
Right.
going to keep the house? Well, in this case, the house is valued at $400,000, but there's a $300,000 note on it.
For sure.
And, then, the biggest asset I see on the screen here is a 401k. Well, if you tap into that, even though she would inherit it, it's going to be taxable. So it's going to be a whole lot less than $350,000, and that's not
if she spends
smart.
that, she doesn't have anything to retire on.
Exactly. So she's in a situation that we see many times. So debt, obviously it would take something to bury final expenses. Then, as many parents, they would like to provide a portion or all or whatever they've figured out for their education expenses for their kids.
They had planned on helping their kids or paying for all of their kids' college expenses, which many people do. We could have another show on that, but which just a kind of a average estimate expense is $25,000 a year times 3 kids. That's $300,000, right?
That's exactly right. So when we were building out this scenario, and we didn't want to take it line by line,
right?
But we wanted to show on the screen here that hey, this is a normal situation. This is a young couple that have kids with a house, not astronomical debt.
Yeah.
But a normal scenario. So as we ran the numbers, and Les, you can speak with this too. So we got income replacement. So if she went to work, then she'd probably have to get a nanny or have significant daycare expenses.
Right.
But then at the same time, there would be a transitional income where I've seen in widow cases, either spouse, whichever passed away, people just aren't thinking right in those first few periods of time.
Yeah, there's just there's transportation costs. There's all kinds of things that pop up that you may not know how to handle, whether you're the sole provider or if you're the stay-at-home mom that or the stay-at-home parent that either one of them going out of the picture changes.
It's a traumatic experience,
right.
And that's what I referenced when not thinking right. It's just a traumatic time.
Yeah,
it's a traumatic time, and there's things flying in from everywhere that you may not have dealt, and just scenarios that you want to take care of your kids. And the education expenses, we covered that for the 3 kids. And then also just to have a slush fund of emergency reserves is important. So what we figured out in this scenario, as you ran the numbers.
So, I mean, to fund that, they would need a savings. If they would need to have in a savings account or investment account about $1.8 million today. To be on top of what they already have to cover all those needs. So, life insurance provides that opportunity at a much smaller cost than saving $1.8 million. Now, this is if Tom were to pass away today.
And as we talk, when we explain life insurance today in their scenario, assuming no significant amount of debt is accumulated after today in this scenario, that over time the assets are going to increase, and today's life insurance need is probably at its greatest. So as debts decrease and assets increase, then the need for life insurance probably isn't as great. But we're solving this picture for today, and this is where a potential term policy could come into play.
Right.
And in a scenario like this, the cheapest insurance for the most amount of death benefit, and covering a period of time until the kids are out of school, college, until potential debt's paid off. Then, having a life insurance to cover that need today, and many times you may stagger a couple policies, whereas you have a 30-year term or in a 20-year term or a 20 and a 15 to cover that period of time.
Right.
And we could get into but the bottom line is there's a significant need here.
Yeah. Well, and I mean, to emphasize that, if that income is gone from Tom's death, his family has to act quickly, and their lifestyle is going to dramatically change. I mean, probably sell the house. If they don't have life insurance in place, probably sell the house. Kids are probably going to have to find their own way to pay for college or just not go to college. Wife's going to have to go to work. And you think maybe you're dramatizing this. We see it. People are having to make those decisions.
Yeah, this is a real life scenario. So as soon as people think it won't happen to them, it unfortunately happens.
One other thing I want to kind of bring up about this situation is Tom works at a corporation. The corporation actually on their benefits package has a life insurance, and it's 3 times his annual salary. So that's $400,000. And you would factor that in to, how would that help offset some of the other insurance you might need to fill that gap if something were to happen to Tom. But, the downside to those policies, and not to get too in the weeds, the downside to a policy that's at your company, when you leave that company, which people do on average about last I saw was like every 6 years, people change jobs. It may be less than that now. That insurance policy doesn't go with you. It's done. It's you don't get to take it with you.
It's a group policy.
Right.
So it is a lot cheaper than having an individual policy. But if you don't work there anymore, you don't have the insurance, unless in a very rare cases, there are some companies that offer a policy that's still group, but it's portable.
Right.
And you can take it with you when you go. But that's very seldom that we see that. We work with a company and have some clients with a company in town that does have a portable policy, but it's so rare. And so that's a good point.
So, but it's not, I would take advantage of it. It's usually pretty inexpensive to get. Take advantage of it most of the time, but don't necessarily just count on that meeting all your needs.
That's the icing on the cake. That's not the cake, is the way I explain it. So that's good. We've got another scenario here that's as we have some clients in this particular situation. So Les, I'll let you take the lead. The asset map, there's a lot more stuff on that picture than the previous scenario. Yeah,
so John and his wife, Jane, are in their mid-50s, and John's a small business owner. Worked a long time. Business is somewhat successful. Has done a good job with his business, and he's accumulated some significant assets. He's has a net worth of about $5.2 million. So you would think that he has everything taken care of. If something happened to him or Jane, that he would have plenty of money to cover the rest of whoever's left behind's life. But going through some analysis here, he doesn't have a ton of just money that's liquid in his savings. A lot of his money's tied up in his business. Nice. He's got a business partner, like we were talking about. So if you'll notice on here, he does have a buy-sell policy, as does his business partner, which you can't see in this example. But and he does have $1 million term policy. So you think, he's got $1 million.
Well, the buy-sell, that wouldn't go to that in this scenario. That goes to the company. That goes to the business partner of the company. That doesn't go to his.
That's right. So that goes to help the
business continue to function.
Yeah, his business partner, which is also he wants to take care of if something happens. So he's got some insurance though. He's got $1 million. His wife has $500,000. But when you look at the analysis on that, because he has a fairly significantly high income from having a successful business, $250,000 a year, and then he's got some other retirement benefits and that kind of thing. If something were to happen to John at age 57 here, to take care of his wife for 10 years and have the transitional income. He also wants to, and we see this a lot. He's got a couple kids that are grown, that have grandchildren and that are starting to have young families, and and it's always been a goal of his to leave something to them. So he would like to leave them $500,000 each. When you look at that, he's underfunded. Even with that $1 million policy, he's underfunded by about $4 million,
Right.
which sounds just like a crazy amount of money. But what we didn't talk about is he's also got debt that he's got to pay off. I mean, he's still got, he's still got a mortgage, a small mortgage, and about $200,000 in a mortgage, and then, but really it's to keep that lifestyle for his wife.
To maintain the lifestyle, continue the business, and leave a legacy. And we are taking in our business, every situation's unique. So if you're sitting there listening, like, this is crazy. That's not, no, you got to put that person in their shoes, or put that person in Jane's shoes here. To maintain that standard of living is what, I jokingly say that I don't want to, if I'm not here anymore, I don't want to have too much insurance on me, because I don't want to finance another man's lifestyle on the beach with my wife, But I do want them to maintain her standard of living, love my family, my kids, my wife, and I want to see that. So in his scenario here, that's a different situation than the previous one we looked at. And to maintain that standard of living, that's what would be needed. Now, at the same time, as we talked about previously, there may be, depending on politics, a potential estate tax situation in this scenario, because
that's exactly right.
You said that his overall net worth right now is 5.2.
Yeah, so that would put about 1.7 million, right?
Yeah, it's proposed 11.7 is right now per individual, and it's currently, and proposed is 3.5, and that's just in today's numbers.
So if his assets don't grow at all, and he passed away today, and if he passed away next year, and the proposed new policy for the real estate tax.
Him and his wife passed away, and it went to the kids.
Mm-hmm. There would be tax on anything above that 3.5.
That's right. So you're talking about $750,000 possibly in tax.
And it used to be a really high rate.
Yeah, and it's up around 50%. So it's a significant amount of money. So you got to think through things. It's not just about replacement income, but.
And we didn't run the policy quote on this or anything, but just it would be pennies on the dollar on $750,000
for someone in pretty good shape.
That.
So exactly. Especially the younger you are, the better. But it's something to look at, and because you don't. Uncle Sam's going to be very happy.
That's
but this is a way to offset some of that risk. But, those are two specific situations. In scenarios like this, there's the potential for term, but also permanent insurance. Because, remember, permanent, you have the insurance it covers the insured person until the end of their life. As long as you pay those premiums and the policy's paid up, then you have those. You have insurance, and a death benefit will be paid out. So that scenario screams permanent life insurance for at least for a portion of the coverage, and term possibly for others.
Sure. Another thing that a scenario that's popped up that we've had to deal with in the last year or so is a couple clients that have owned real estate, and they may have a loan on the real estate or something like that. And a spouse dies, they no longer the one that's left may not know how to manage the real estate. They may be in the process. It's an investment, so you're always looking for an opportunity to sell an investment at a profit, right?
Right.
You don't want to be forced into a situation where you have to sell immediately, because the timing may be terrible for that.
Right now it might be great. The real estate, as we're recording this, real estate market's great, but timing is everything in real estate market.
But also if you get in a situation where someone knows you have to sell, it usually lowers the price that you'll get for it. So You want to have the insurance, which brings you back to life insurance. Death benefit gives you options in a bad situation.
That's correct.
You know?
That's correct.
We really feel strongly that it should be. How often do you think that you should review your life insurance policy?
I'd say at least every 2 to 3 years to see if you have the coverage that's needed.
Or if you have too much coverage.
If you have too much coverage is another thing. And that brings us into our final slide is, how can we be of assistance in a scenario like this? We are a resource not only for life insurance, and we represent, I don't even know how many companies. We're not tied to one particular one. I always say, I know it's 80-plus policies that we have the opportunity to quote through. We filter them down based off the most highly rated that provides the coverage needed for the most beneficial from a cost standpoint as well. But we also review current life policies. So clients may come to us and already have life insurance in place. And is it enough? And so we can review policies that are in existence.
Right.
So many times people may be overinsured instead of underinsured. So we could review those policies. And the way we do that is kind of plugging in the numbers to the asset map software that we were referencing earlier. And if you have a phone, you can click on that QR code that you see on your screen. It'll take you there to a link that you can start filling in your information. And then from that, we may have it'll come to us and we'll have some questions possibly for you and a follow-up. And then we're able to run some target scenarios of potential life insurance needs that you may have.
Right.
So it's a very good software we've referenced in the past, and its name's Asset Map. You can also find it online at our website, scretirementplanners.com, and click through the link, fill out the information, and we can make contact with you if we don't currently work with you. So help us, help others. We always say that if you know of a situation where, upon listening to this, you have a friend or family member that you feel has a need for investment direction, but also a life insurance need where you're just scared that they could leave their loved ones without the financial security that they need, then that's something that we could be of assistance with.
And particularly a young family.
Yes.
If it's you've got a child or not a child, but a son or daughter that's starting a young family or know someone, have them go have a discussion with someone about, getting a policy when it's very affordable and something that will take care of their loved ones if something happens.
Right. Yes. Well, this has hopefully been a beneficial podcast and listen for you today. We are passionate about what we do, but we're also passionate about making sure that individuals are taken care of because we have seen several scenarios where there's been gaps and families or have been under some financial pressure that could have been easily alleviated with the right conversations.
Correct.
And so we appreciate the opportunity to share this information with you today. Once again, reference our website and our phone number is 828-855-2067. If you don't currently work with us, we offer individuals that to a complimentary financial checkup is what we call it, where we sit down and learn about each other and your situation overall and see if it might be a fit in working together going forward. So we appreciate your time today, and we'll look forward to you joining us at a later date on another topic. Thank you.
Thank you.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member of FINRA, SIPC. Southeast Retirement Planners is not affiliated with LPL Financial or registered as a broker-dealer or investment advisor.